one of the big problems with the payday loans is that these loans are 300% plus interest rates, which are huge interest rates. And that's the reason why the costs sort of, balloon so much. And typically what we find out is that 75% of the loan volume of payday is made up of borrowers who are in that loan 10 or more times. And so, people get trapped in that cycle of really just like floating that same $350 and end up paying fees that are even larger than the amount they borrowed. A big way to think about scale is that, we're talking about $8 billion a year of, fees, being paid, for these payday loans. The loans are authorized in 36 states. You have another 23 states where car title loans are authorized, and those are loans where a person's automobile is held as collateral. So the big aim is to really stop that debt trap, and that's really the biggest concern. As I alluded to, so much of the volume of these loans are people that are really just refinancing that old debt. And so the biggest thing in these rules is that when we see people rolling those loans over, we know that they don't have the ability to repay that loan and meet their other obligations. And so there's an ability to repay standard that's embedded in these rules, and that's a great thing about the rules. Our biggest concern is that there are some loopholes that allow some loans, and in some instances, 6 loans are allowed without any ability to repay standard. But the fact that at the centerpiece of it, that there is an ability to repay standard means that lenders will have to, as they don't now, assess whether or not people can actually repay those loans and meet their other obligations.